Welcome to Gamma On, Episode 7. I'm Oliver Renick, lead anchor of the Schwab Network. Thanks for joining us throughout this very fun journey. We are more than halfway through using second derivative analysis to amp up our knowledge and ability as traders. Today, given that we are based in Chicago, we have another special guest. Henry Schwartz joins me from the SIBO. He's a VP of Global Client Engagement. And of course, he in some ways represents the home of much of what we've been discussing throughout this podcast. Henry, great to see you in person.
You too, Oliver. It's great to be here.
We've been talking for a while. You've been doing hits on my show for a better part of several years. And of course, during that period, the proliferation, the beginning of the zero-day options market is something we've spent a lot of time talking about. That's going to be at driving force for our conversation today. But I also kind of want to just sort of start with your experience and background. We've got a lot of data that you bring to the table all the time from SIBO, so you guys have so much good stuff there. We're going to kind of get your thoughts on some of these gamma principles and how much they really matter and how much you guys think about them at the SIBO. But first, kind of tell me about your background and how you got into the SIBO and here in Chicago.
Sure. So I've been in the business for over 30 years. I actually started as a runner on the SIBO floor in the 90s.
Beautiful.
And so it's been kind of like a big circle. But I traded for a market maker for about 5 years, worked for 3 different banks in New York City, and then about 15 years ago, I started a market data company focused on option flow analysis. And then SIBO actually acquired us during COVID, and so in 2020. And so I've now been with SIBO for about 4 years. And, you know, it's an amazing company. We were the first options exchange, and I spend most of my time digging into options data and different ways to use it. And, the way that this market has evolved, that we've been talking about, it's just, kind of incredible. The amount of activity, the amount of data to dig through. And then, the zero DTE phenomena really has been, one of the biggest growth drivers we've seen in decades.
I think what gives us some kind of overlap in the zero-day conversation and the gamma conversation, there's a lot in that Venn diagram that meets in the middle. They are like the way zero-day is kind of smoothing the vol surface with more ways to chop up exposure in markets. Where do you kind of view that overlap of zero-day and some of the gamma stuff that people talk about?
Well, it's interesting. Like positioning, right, which is really what we're talking about, has always been an important factor. And then, as this market has, evolved, and now you do have daily expirations, and we spend a lot of time, reminding people zero DTE options are nothing new. But the fact that you do have a daily expiration cycle available, that's new. And paying attention to positioning has always mattered. But when I worked at banks, you would know, a certain client was long a certain block of options, right? And on top of that, you might even know kind of what kind of account it was, right? If it's a fast money hedge fund, you may kind of treat that information a little differently, right? You may be very wary of that kind of position versus maybe somebody's overwriting, right? And it means they like the stock, they just kind of want to pull in a little income. So that kind of a position doesn't have the same information in it. And so,
that's a great point.
So where we've gotten to now, especially, there is kind of a whole specialty. In fact, there's people that trade zero DT options exclusively, right? And there's strategies that really, that are, specifically, they may be just a few hours in length. So, looking at the data, right, we see how much activity is trading. We see, SPX was the first product to have daily expiration cycles. We had Fridays for almost 12 or 13 years, and then we filled in Monday, Wednesdays about 6 years ago, and then in 2022, the Tuesday, Thursdays were filled in. And there was a weird tipping point. I think even SIBO was surprised by the fact that the option volume had always been heavier on Mondays, Wednesdays, and Fridays. So when we decided to add in Tuesday, Thursday, it was like, well, there seems to be a lot of activity going on those days, so let's fill it in. Mm-hmm. But the fact is that made some strategies possible, like daily strategies that just really people weren't even doing when there was Monday, Wednesday, Friday. So now you have almost half of the activity in SPX, which is the biggest index product, 1.5 million contracts a day trading in the zero day. That's half the activity. But you also have an enormous amount of zero-day flow in comparable products, SPY, the NDX index, Qs, even Russell.
You mentioned something I want to come back to for a second, which is about how would you kind of generally characterize, you think, sort of the transparency of the data for those who are trying to now take these data points and use them as part of their trading strategy. People who look at gamma exposure, people who look at open interest levels, flows, stuff like that. How much do you think that really tells us, and what information don't we have when we're just looking at the screen for those numbers?
Right. Well, so the 0-day options really are very interesting because of the fact that most of the activity in the dailies takes place on the final trading day. And the way that options are cleared through OCC, open interest is only distributed once a day, meaning that if most of the activity is going to happen on the final day of trading, you actually never get any open interest figures from the clearing corporation. So so you have to kind of use a couple of different approaches. And one is, as you said, you can see the activity, right? You look at volume, or you look at time and sales, and you can see, okay, the 6,200 puts that expire today, we see the activity, right? We see 80,000 of these contracts have traded. But what you need to do, or what participants do, is employ a bunch of different approaches to really try to figure out if there's an imbalance. And that's, the concept of gamma, is about an imbalance. It's about, is one side hedging the trade dynamically, which may have some market impact, and then if so, which side, right? Because, if you think about it, and there's a lot of discussion about this, especially with the ETFs that sell optionality.
Right.
If there's a lot of supply of options into the market, and the people that the groups that tend to do the dynamic hedging are going to be the market makers and the liquidity providers. And so if there's a whole bunch of options being sold, then they're long a bunch of options. That gives them positive gamma. And so if the market starts to go up, they have some futures to sell, or stock baskets to sell, or whatever. And the market comes back down, and they have futures to buy. And that tends to be a stabilizing force. And there is academic research on this. People really, it's all pretty new, but people are trying very hard to figure out what's the impact here. So if you kind of take that concept down, and then the vice versa, if the order flow is buying options, especially if it's buying a lot of options, then the dealers are going to be short gamma. And so if the market goes up, they actually have to start buying futures or S&P 500 baskets or something. And that's kind of destabilizing, because the higher it goes, the more they have to buy until that strikes kind of in the money. So
that second scenario is seldom compared to the first scenario, right? For the most part, it's a stabilizing force. Is that fair to say?
That's what we've seen. The new customer base that's been kind of pulled in, and also these new structured products, the yield ETF universe, which is kind of a gold rush of its own, are premium sellers generally. So because they're coming in and selling options. Now, usually they're doing it in some sort of capped fashion, right? Maybe they're selling a vertical put spread and vertical call spread, the condor selling community. We see in the data there's in the first half hour in SPX at least, there's about 50,000 contracts that are sold in the form of condors. Okay, so if the market's at 6,000, they're basically selling a put spread that's slightly out of the money and a call spread that's slightly out of the money. So the liquidity side of that is long options that are slightly out of the money. And then if the market moves a lot further, then you start to hit the caps on those. Now, the truth is, the market, we really haven't seen too many big moves.
Right.
So in general, it has been a stabilizing kind of net flow.
Sure.
I think it's a good idea to pay attention to kind of what people are doing and try to get the best possible read on, like, okay, market's at 6,000. We can see in the data that there's a lot of activity, say at the 5,900 and the 5,800, and then you have to go in and try to figure out, okay, are they selling the 5,900 and buying the 5,800?
That's where it gets trickier.
It's where it gets trickier, but the data can really be helpful. So there's a data source that SIBO has called the Open Close data set, which actually is a dissemination of customer side for every contract in 10-minute intervals. And you can actually just basically you can net that out. Say, okay, we see customers bought 6,000, 7,000, 8,000 of these contracts, but they also sold 5,000, 6,000 of these contracts. So there's the net that the dealer is potentially hedging is just that remainder. And so what's interesting is, and I've looked at this data, even on days where there's 110, 120,000 contracts trading in a single contract of 0-day, if you do customer long minus customer short, we rarely see positions that are very big.
Okay.
I'm talking like 5,000, 6,000, 7,000 contracts. And now it does get a little bit more complicated because you actually, to kind of get the best view you possibly can, you want to look at other products, right? You want to say, well, okay, fine. So to the downside in SPX, I can see there's 6,000 contracts net. But you do have to realize there's comparable products. The liquidity community is very sophisticated in how they're laying off their risk. So it's hard to get a perfect read, but you can get a pretty good estimate. And then, and then as we were talking before, you're also trying to kind of anticipate how are other people looking at this information, right? And if there becomes a big focus on like, wow, let's say the market's down 2 or 3%, hasn't happened in a while. But if the market's down sharply and there's a large position and people are starting to pay attention to it, it's almost like game theory.
Yeah,
people are like,
it's self-fulfilling kind of reality.
Exactly. And then like, okay, well, what are people going to do around that information? And so people are kind of trying to stay one step ahead of the competition.
You sound a lot like what we heard from Devin Anderson from Convexitas, also a local Chicago shop, and his experience at banks as well, which comes back to your point about the multiple products with which a big market participant can choose to lay off risk. We might look at the notional exposure from the gamma perspective on a position, but we don't know what else they have on their books. To his point, what other customers or clients may be open to take on that risk, which would then lessen the degree to which they have to kind of chase their tail, which is what we're kind of hoping for as traders, that, maybe these big levels or these big participants get kind of pinched, and if I'm in the right place, I can ride that push. But to your point, a lot of times the actual meaningful exposure is probably lower than what we see, and compared to the rest of the market volume is largely going to be something that's not a major impact, I don't think.
Yeah, and we also, in the U.S. we have kind of an advantage in that most of the activity taking place in derivatives is listed, right? It's not a big OTC market in the States to begin with. And on top of that, when you look at the 0-day, because it is a very heavily retail and market maker kind of usage, there's actually not a lot of firm activity or even really big hedge fund activity in this short-term 0-day stuff. There's some, but so because the data is kind of what it looks like, you're able to see most of what's going on. And so, exactly like you're saying, there is like, if somebody buys some 0-day options in SPX, the liquidity provider who sells them, okay, they're managing their risk. This is what they do for a living. So, they're not likely to panic, right? They're doing things very methodically. Right. And on top of that, I've talked to some of these liquidity providers. They tend to run a 0-day desk. That's all these, a team trades. They have very strict risk limits. And so we actually see it in the data. If you look at one of the data sets I like to look at is the clearing volume by account type. So there's customer volume, firm volume, and market maker volume. And generally, it's kind of like, 40 or 50% customer, 10% firm, and 40 or 50% market maker, because in general they're kind of offsetting each other. In the 0-day, which you can look at it individually, we actually see more market maker flow in 0 days, like 60%, which means the market makers are actually trading with each other. That's for basically because they're laying off risk. They're being very kind of strict about how they're, you can't have more than 800 contracts of strike risk at the 6,200 line. So they just go buy it from each other.
Which is why it's generally more a stabilizing force for the most part, which kind of then brings me back to something else he said, which is that if enough people are looking at something, though, and then sort of exogenous events happen that start to push the market in a direction maybe that those big dealers were not prepared for, it does start to get them in sort of a negative gamma situation, or it then brings up those opportunities, those moments where maybe this does add some convexity onto the market, where you can get faster moves that can turn cheap, low probability contracts into suddenly expensive, higher probability fun swing trades, which is why I think people look at this. But that ultimately is kind of just a different version of what people are trying to do already, which is figure out what levels matter, where we might be going. There's a lot of overlap, I feel like, in the way people think about technicals. If somebody's looking at, all right, there's this big call wall or put wall somewhere, similar to the way I think technicians would feel about like a moving average or something, or maybe that's a little bit older. But if you think about like how people pitch stuff in the 80s, 90s, when like people were really getting in day trading for kind of the first time, there are all these levels and technicals, and if enough people are looking at them, and the hot technical measure is, that can create a real force.
Well, it's true. I mean, the concept of kind of like a crowded trade, right? Even in the institutional world, like, people look at a trade, they're like, wow, if there's, if the trade starts to kind of outsize the market, that's where there's kind of an element of danger, right? It's
Sure.
That's where we were talking a little bit about dislocations and kind of, what we saw during COVID. Like every once in a while, markets break. Usually it's temporarily. But so, a crowded trade where, there's basically just too much capital allocated to a single strategy, that's where things can get kind of weird. Now, I mean, in the S&P complex, I think we see about $2 trillion a day in notional value trading. It's an incredibly liquid product. I do think that it's important to keep an eye on. I mean, even at the simplest level, right? There's some groups that trade with pretty simple rules, right? They're going to sell, like I said, maybe a condor. One of the reasons that we see the positions never get very big is because it's when anybody's trading a rules-based strategy, you can kind of anticipate what they're going to do, right? They sold this option for 70 cents, and if their rule is to basically take profits at a dime or stop themselves out at $2, if that option starts to approach $2, you actually can kind of anticipate some activity, and that is where that's where kind of the gamma concept kicks in. Is
where it gets fun.
Gamma lets you quantify how much dollar value of rehedging is going to be necessary at a certain market level, and then kind of having an understanding of what trading strategies are being used. Gives you a good chance to anticipate activity. But I do have to say that we don't see just one kind of flow. One of the reasons this zero-day activity is so massive is there are certain types. There's premium harvesters, right? People that do just what I was saying.
They want income. Yeah,
they want income. They have a rule-based approach. They back test it. They like the way that it works, and then they literally might just program it up and automatically execute it on some sort of a schedule. But then you also have kind of the other side. People are coming into these products because they love the kind of the ability to kind of tactically get in, and they're so liquid and efficient that and that's one of the most important things is they're kind of overcoming the bid offer is you're talking about, at least in SPX, a $6,200 index. These options are a nickel wide, and literally they're trading like water. So people can get in and out of trades, and they don't have to get over this big hurdle of slippage or bid offer. So the fact that you do have buyers and sellers really on a continuous basis is kind of why we see, almost without fail, 1.5 million contracts in SPX that are zero-day trading. We see 3 or 4 or 5 million in SPY. But the other thing that's important in the zero day is if you think about like August 5th, right? That morning when the Nikkei was down 12% and there was some panic going on. The zero day activity that day was actually really light.
Interesting.
And we actually talked to some participants, and they said we're not going to trade on a day like that.
Okay.
And that's what's so interesting, and that's actually one of the reasons. Yeah, it's like no, we're just going to sit it out. And they do, and so that's a really fun, interesting dynamic because. People talk about the dangers of selling puts, right? There's people certainly can get hurt being short options. But if you kind of get to decide, I'm going to trade today or I'm not going to trade today, nobody can really predict the future, but you can look at market conditions. You can look at, there's a Fed meeting, the Fed announcement at 2 o'clock today. I'm not going to put a position on through 2 o'clock. I may put something on in the morning and close it at 1 o'clock. But the thing is the ability to kind of limit your activity, that kind of trading, has really attracted a whole new community, and that's why we see so much activity.
That point there is important too, because one, the idea that when there's a big market event, there's sort of like an adverse event or a negative event, it kind of makes sense that people might then actually think about longer-term contracts, because then it changes. It gives you a clear sort of expected return then, because things usually don't go down. Things usually are not volatile. So you're probably more comfortable taking a little bit more duration risk, if you will. on some of those reset days, kind of like a buy the dip notion in a way. But the other thing too is that I kind of described it earlier as the vol surface being smoothed a little bit, and I still kind of have trouble pinpointing the description of what I'm trying to say with that. But the idea is that the more liquid a market is, the better. Generally, the more price is discovered, the more literal options there are, then the more likely you are to find the correct outcome for something, a very specific outcome. It's kind of analogous to like if you were an active manager versus somebody that can only rebalance once a quarter, once a year. Like that's probably not going to be the most efficient way to get exposure to things and pick up on the opportunities in markets that go by very quickly. So I feel like the tool in the belt for the 0 day is very much in that realm. But then it also kind of begs the question then, well, like, how much more could we chop this up if we wanted to? Like, is there a way to go intra-daily?
There was some discussion about doing options that expired at noon. I doubt that we're going to see that, just because there's a little give and take in terms of creating products that people want to trade that really do meet some sort of need, but not fragmenting liquidity and the activity too much.
Okay, yeah.
And so, I absolutely agree with what you were saying in terms of the transparency that you get by having.
But you can't
daily
fragment down to
expirations.
infinitum. Or else, what are we doing?
I think that, and on top of that, I think that the settlement process would start to get really challenging.
Right,
So I think that the industry has kind of hit this sweet spot where people are using 0DTE for different approaches. People understand them. There's some discussion about short-dated contracts in some single stocks, but right now it's indexes and ETFs, and really just the super liquid ETFs. But the fact that what was interesting going into the election, right? You can use the volatilities of each daily expiration, and isolate the forward vol, which basically let somebody actually I use ChatGPT to help me with the calculation. But if you say, okay, I have these implied volatilities of the next 2 weeks, and I want to know what the implied volatility for this one date is. And so for election day, we could see that the implied move was almost 2%. The market was pricing in a 2% move. And you had that perfect information in terms of what the market expectations were because you had an expiration day, each day before the election, and then the day following the election, and you could basically isolate it. And it's the same thing we see with stock into earnings, right? Yeah. But into earnings, sometimes you're like, well, earnings are Tuesday and the straddle expires Friday, so you can still imply a move. It's not as accurate, right? You start to have to make some more assumptions to kind of reflect the information. And the truth is, like, having this I spent decades kind of fitting volatility surfaces.
Yeah.
And if you had a June expiration and a SEP expiration, and somebody said, well, I want a July contract. Like, well, there's no options trading in
July.
July.
How'd you price that?
I'll do some sort of interpolation to get the best possible estimate. But now you have the market, basically coming in with that kind of collective information. If it turns out there's an event in July, it's not going to just be some smooth interpolation. It actually has to reflect the other information. Maybe there's maybe there's an election.
Yeah.
So
it's a great point. I love that.
The fact that this, that we're now at a I think there's 90 expirations, between now and the longest dated, and that you get a smooth liquid volatility surface. Kind of across that whole spectrum, really does that gives you the market expectations for what to look for.
Fantastic description, and also kind of the utility of that becomes very clear. You got some good stats, some numbers that I want to point out here. It also harkens back to what you said earlier about how most people are using these. Customers, according to your data, generally entering limited risk positions. And this is for 0 DTEs or just general?
For 0 DTEs specifically.
95% are either buying or selling limited risk spreads or buying calls and puts outright, of course, where your risk is defined as well.
Right. Yeah, that's it's a side effect of the fact that your margin is pretty high if you're going to sell uncovered or cash secured options. But also that that you have so many strikes available that it's easy enough to cap your risk. And in many people or traders are kind of looking at these as what's funny is you can take all the option math and the binomial and all these funky approaches, but with a 0 DTE contract, it's pretty simple, right? It's here's the price it's trading at. Basically, where do you think the underlying is going to be in 6 hours or 3 hours or 2 hours? So the math actually becomes much simpler. And so a lot of people are looking at these as like, look, this is my bet. Is this options trading for 40 cents? Do I think that the chance of the underlying of that contract being 40 cents in the money or more is a good risk-reward trade-off for me? And so that's the people just buying, using premium to buy and effectively take advantage of the leverage that's built into an option, right? I did some rough calculations on kind of leverage after hearing some people talk about it. And if you basically just take the straddle price divided by the delta, that's a good estimate, right?
Okay.
And so the leverage in a 0-day option, it starts out, you're paying for this leverage in decay. Starts out around 300 to 1 in the morning, gets as high as 1,500 to 1 towards the end of the day. It actually kind of gets infinite by the end, right?
Sure, yeah.
A 20-cent option could be 100 delta.
Vertically.
Exactly. So, but that there's kind of a it's a double-edged sword.
That's why people like them.
Exactly. It's why people like them.
Yep. Especially like the day traders really like them, and sort of the individual traders, because that's where you can put in a small amount and potentially get a lot.
Yeah.
But your probability is pretty low to get that trade in. Whereas the other 95% of the people you're seeing in your data are doing basically opposite.
They're saying, especially if you're gonna be trying to attempt to harvest premium, then you can say, here's my my reward is the premium collected, and my risk is the distance between strikes on a vertical. And it's actually, that's one place where index options really have an advantage over physically settled. Is that index options are really simple. You got the settlement price, and then it cash settles. There's no question about things moving after the close, or things pinning to strike, right? Which can happen in an ETF. And so that can make a vertical spread a little bit gnarly in terms of like, well, it's 30 cents in the money, so one side's going to get exercised. But then after hours, an ETF moves. The market keeps trading after 4. And maybe it means you have to pay very close attention to kind of what the market's doing after the close. So in the index world, it's almost like a binary event. Like I sold this thing for 50 cents. I know my risk is $3 or whatever the strike distance is, and there's not really any way that can be very different, right? So that's kind of the way we see people coming in with capped risk strategies. They sell an option, they buy something further out of the money. And then they have rules or some approach to kind of take things off that are profitable. They may leg out of it. So we actually see more spread trading in the morning and then more outright trading towards the end of the day, which can be people taking profits, basically closing the short leg.
By then, some of it has been closed out.
Exactly.
Got it.
And then it's also, we see people stopping themselves out if something does go against them. But the one thing is the strategy is very consistent. They come back day after day and do it. In general, it's a very fairly priced kind of, the market does reflect the risk. So if you kind of, bought an at-the-money straddle every morning, there's days you make money, there's days you lose money, but really on the long term, it's almost zero. So, which is kind of what you'd expect if it's fairly priced. There's periods where that's a losing trade for, 15, 20 days in a row.
Right, but that's a rare streak.
Exactly. And same thing on the other end. But really, the market's pretty good at kind of reflecting the risk.
You don't often get a lot of 15 coin flips landing one way in a row.
Exactly. But it's possible.
Cards, and you see it a lot. You see it way too much. We're going to definitely continue our conversations on the show because we love having you on and always appreciate the insight and the data you guys bring from SIBO.
All right. Anytime.
Absolutely. Thank you very much. Henry, great conversation. Henry Schwartz, fantastic stuff. A big thanks to Henry Schwartz from SIBO. Really great commentary, great data, and a great understanding of the subject matter. Really enjoyed that conversation. Feel like we could keep going. By the way, Devin Anderson from Convexitas will be on in the next episode. Hope you enjoyed the teaser for a bit of a contrarian take we're going to hear from him on the subject. Don't miss the full conversation right here on Schwab Network's YouTube and Spotify channels. And be sure to subscribe. You can find all episodes on schwabnetwork.com. Thank you for tuning in. I'm Oliver Renick. See you next time.